What's going on, guys? StockScrubay here, back again with another video. Hope you guys are having a great day. Today we're going to be talking about the Federal Reserve, them raising interest rates soon, what that means, and a couple of companies' earnings. Obviously not financial advice, I'm talking over gameplay, and without further ado, let's go. Alright, so earlier today, the Federal Reserve, the people in charge of printing money, ended up having a meeting and a little bit more of an explanation of what's to come. The market freaked out a bit, so I figured we would talk about it. Federal Reserve points to interest rate hike coming in March. Honestly, a lot of people are really surprised by this. I feel like everybody kind of knew that interest rates were going to raise this year. They had already confirmed that, and yeah, March probably seemed like the closest time they were going to raise rates. Obviously, it's not the greatest news of all time, but I don't understand why everybody's so flabbergasted by this. I feel like this is something that we've all known is on the table of something that could happen for quite a little bit now. Money printer can't go burr forever. It's just reality, you know. We've talked about how they've printed like most of the dollars to ever exist in the last 2 years. That's not sustainable forever. At some point it had to turn off, you know. They had to start raising interest rates. The economy and inflation's just way too hot right now. The Federal Reserve on Wednesday provided the clearest hint yet that it could start raising interest rates as soon as March. With inflation well above 2% and a strong labor market, the committee expects it will soon be appropriate to raise the target range for the federal funds rate, the central bank said in a statement that concluded its two-day meeting this week. Fed Chairman Jerome Powell said asset purchases are likely to halt in March, and the central bank released a paper outlining principles to start reducing the bond holdings on the balance sheet without indicating a specific time frame. So, yeah, basically, you know, the Federal Reserve has been printing money and buying, like, a certain type of security with it, which has been putting liquidity into the stock market. All liquidity means is money. A lot of liquidity, money sloshing around tends to raise prices. There's a little too much money flying around, so they're going to stop doing that, basically is what that means. That being said, I can't help but think it's hilarious that they're like, with inflation above 2% in a strong labor market, I don't necessarily think you could call the labor market strong right now, you know? Nothing against anything Jerome Powell's saying. It's just the reality that everywhere you look, there's a worker shortage or a shortage of this, a shortage of that. To me, that's not a strong labor market. If you're having shortages of basically every worker at every level, that's not a strong labor market. That's just my opinion, though. And also, inflation well above 2%. 2% is kind of the goal of the Fed. They try to aim for about 2% inflation a year. No inflation isn't healthy. The reverse of inflation, deflation, is definitely not healthy, but a little bit of inflation is okay. That's normal. 2% tends to be the goal. That being said, well above 2%, which is what they said, it's been about 7%. Well above 2%, yeah, just a 5% gap there. Obviously, they don't want to come out and admit that inflation is tracking at like 5, 6, 7%, because that just means that they've done a horrible, like, job at what they're supposed to do. And, you know, no one's dumb enough to come out and say that in the meeting. Yeah, I don't care, like, what your job is. You're never going to come out and be like, we really messed up and made a major mistake, and this is our problem. Inflation well above 2% and 7% are technically the same thing. One of them just prevents you from getting in as much trouble. As for what all this means, you know, what does this mean for like you on a day-to-day basis? I found an article that outlines it, you know, and there's no reason to be freaking out. I promise everything's gonna be okay in the long term. I can't promise the next like year is gonna be fun, but long term it'll be okay. The Fed got the memo. Here's what you can do to prepare for the coming rate hike. The cost of borrowing will rise as the Fed unwinds its bond purchases. Long-term fixed mortgage rates are edging higher since they're influenced by the economy and inflation. The average 30-year fixed home rate has risen to 3.75% and is likely to climb to 4% by the end of 22. So if any of you are in the market for a new house, yes, your interest rate is going to go up, but you know, in the grand scheme of things, this just was going to happen. Interest rates on a 30-year loan being like, what was it for a bit? 2.5% on average, I think I saw. You know, don't quote me on that. I'm not a financial expert. This is entertainment, but I think it was around there. It definitely was 3% for sure. That being said, that is insanely low. Like, oftentimes the average interest rate has been well above 10% in American history, so 4%, while it's obviously a bit higher, I think it was artificially low before. Like, there's no reasonable reason it should have been as low as it was for as long as it was, so I'm not surprised that we're starting to see a little bit of a raise there. And I don't even necessarily think it's the worst thing in the world. Housing prices have been climbing like crazy, and usually higher interest rates tend to slow down how fast housing prices can grow, because it means that less people can borrow as much money to keep the housing prices going up as much. Shorter term borrowing rates, especially on credit cards, will head higher faster. Since most credit cards have a variable rate, there's a direct connection to the Fed benchmark, so expect it to rise when the Fed makes a move. Currently, credit card rates are around 16%, down from a high of 17.85%. A small increase or two spread out over several months isn't going to rock most people's financial world. However, several small rate hikes begin to add up, and for folks with a lot of debt, any increase in interest is unwelcome. That's why people need to take action today. Borrowers could call their credit card issuer and ask for a lower rate, switch to a zero interest balance transfer credit card, or consolidate and pay off high interest credit cards with a home equity loan or personal loan. Cards offering 15, 18, and 21 months with no interest on transferred balances are one of the best weapons in the battle against credit card debt. Alright, I understand a lot of people get into credit card debt, so if you're in that situation, obviously pay it down as fast as possible because it's going to start costing you more money. That being said, that's the best weapon to fight credit card debt. You know what the real best way to fight credit card debt is? Don't get into it, dude. No financial advice, alright? This is just my personal stupid opinion, no financial degree. If, a credit card is 16% interest and it can raise or lower, let's say that you put $1,000 on a credit card. Every year you're paying $160 that you don't pay that back. All right, or okay, you just look at it and go, if I don't have $1,000, I shouldn't buy it. Why are you going to pay more money to buy something now? To me, it just doesn't make sense. Obviously, if you have to put something on a credit card every now and then, it's reality. I've had to put stuff on a credit card before. I'm not saying I don't have any of them. That being said, bro, a lot of people, even people I know, treat their credit card it's just a bank account that eventually they'll pay down, but they're not worried about it right now. And listen, that's pretty irresponsible in the first place, but it's really irresponsible when that debt's got a crazy high interest rate and it's gonna grow crazy fast. Let's say that interest rates go up to 20%, right? You take out a bunch of credit card debt, whatever, I'll deal with that in 5 years. In that amount of time, at 20%, that's gonna double. A little bit more than that, because I don't know if it compounds. I'm not exactly sure how a bunch of credit card debt works. Like I've said, I've never had a bunch of it. That being said, it's at least going to double, probably more. So, yeah, you're really gonna end up paying quite a bit more for it than you ever intended. Just avoid credit cards, or if you are gonna use a credit card, make sure to use it like a debit card. In my opinion, this isn't advice. If you have $100 in your checking account, then that's how much you should put on your credit card, and make sure it's paid off so you don't gotta pay interest. Like I said, that's just my personal experience with credit cards, and credit card debt is horrifying because it grows so fast. Savers get squeezed when the Fed does raise its benchmark rate. Deposit rates will be much slower to respond, and even then, only incrementally. While the Fed has no direct influence on deposit rates, they tend to be correlated to changes in the target federal funds rate. As a result, the savings account rate at the largest banks have been hovering near rock bottom, currently a mere 0.06% on average. Alright, so to break that down into English for people that don't really know what that means, basically, if you have money sitting in a savings account, right, the bank pays you interest for leaving that money there. Currently, it's about 0.06%. That's absolutely garbage because inflation is around 7%, right? So that means 6.4% a year is what your money is actually losing. If you left $1,000 in a bank account with 0.06% interest, over the last year, you've lost 6.4% of the value of that money. Sure, on paper, it still says $1,000, but that dollar doesn't stretch as far as it used to because stuff's way more expensive. So there's a saying called cash is trash, and that's not always the case. Inflation rates aren't very high. And once again, not advice, I'm just an idiot here, but the rule usually goes that if inflation's high, cash tends to be less of a priority to have a lot of, because it's hard to get an interest rate that's going to beat inflation. Why am I going to have all this money sitting here knowing it's losing 6.4% when there is a way to buy a bond and at least get 2% or whatever it may be? You can invest it in stocks and risk and maybe get 12% a year, which is the average. There's just not a whole lot of reason to have a crap ton of money sitting in the bank right now. Next up, we're going to move on over to the king of the meme stocks, Tesla, which went over its quarterly earnings, and they were interesting, especially the reaction to it. Tesla earnings are out. Here are the numbers. Tesla shares fell 5% in extended trading on Wednesday after the automaker reported fourth quarter results that came in stronger than expected. Here's how the company performed. So they actually earned $2.52 a share versus the $2.36 that was expected, and they ended up making $17.72 billion overall in revenue, and only $16.57 billion was expected. So overall, revenue rose 65% from quarter 3 to quarter 4, and on top of it, the overall income was up 760% from the year before. So overall, not doing too shabby. That's why it's really confusing that the stock ended up going down 5%. This is just my opinion. I feel like it's definitely the reality that we were in a bubble. Stocks were immensely overvalued. Tesla happened to have led the charge on those stocks that just went absolutely bonkers last year. So sure, while it did do better than a lot of people expected, due to the nature of how much Tesla has gone up and, the stock market's been getting slaughtered recently, everything's down, the Fed's going to be raising rates, people just are unsure of what situation's going to be coming. It doesn't surprise me that even though Tesla did better than expected, that the shares might be losing value a little bit today. You just got to look at the rest of the market. The one thing that investors tend to hate more than anything is uncertainty, and as it currently stands, the Fed might and probably is going to raise rates in March, but they might not. We don't know when they're going to stop purchasing assets. We don't know how fast they're going to get rid of the assets that they do have, how much that's going to unravel everything. It makes it hard to know what the future of a company is going to be if everything around it is uncertain. So overall, Tesla's obviously a beast of a company. Anything that can raise revenue 760% is absurd. But you do have to sit back and consider what the overall state of the rest of the market is, which is why I personally think that it went down, even though this news should have been a good thing. The other company that I wanted to talk about that released their earnings today is Intel. Intel reports better than expected revenue and delivers upbeat guidance. Once again, you'd think that'd be good news for the stock price. Intel reported fiscal fourth quarter earnings for the period ending December 26 after the bell, and shares slipped about 2.5% in after-hours trading despite a beat. Here's how they did versus estimates. So they ended up earning $1.09 a share versus 91 cents that was expected, and they ended up making $19.5 billion versus $18.31 billion expected, and they said it expected $18.3 billion in adjusted sales in the first quarter, beating consensus expectations of $17.6 billion. Usually a company saying they're going to make more money than expected during the next quarter and saying that they did better during this quarter would once again lead to an upswing in price. But I just think we're in this really weird market where stocks have really only gone up for an extended period of time, and now that there's a bunch of uncertainty, people really aren't sure what to do. And on top of that, because the last years have been so good, if that uncertainty's here and you're looking at your portfolio, you're like, all right, everything's down 10% in the last week, but I'm still up 400% in the last 2, 3, 4 years, however long you've been holding stuff. Chances are you're going to be taking some chips off the table just because, there is an uncertainty. Why keep money on the table if I'm not sure what's going to happen? And it just so happens that tech is the place where a lot of this bubble has been concentrated. It just is what it is. So I'm not surprised to see both Intel and Tesla kind of having this happen to them. Obviously, it's not great. I don't think either of these companies is going to disappear tomorrow. I would be flabbergasted if in 5 years they both still don't exist and are huge. That being said, I just think the reality of the situation is there's a lot of uncertainty in the market right now because of the Fed and everything going on, so stocks might not be doing too hot for a bit. Obviously, I could be wrong. I hope I'm wrong. Maybe stocks quadruple in price. I look stupid. We all get more money. Everyone's happy. But overall, I just wouldn't be surprised if you see more beats coming out and companies having a harder and harder time pumping their price higher until we get more concrete plans on what's gonna happen. Anyways, guys, I think that's going to do it for the video. Hopefully you enjoyed. If you did, I'd appreciate you taking a second to press the like button. Let me know in the comments section down below what you thought. And, of course, subscribe if you're new and turn on those notifications. If you really want to help me out, I'll go ahead and put a link in the intro song down below, along with a link to my podcast, The Scuffed Cast. Or, of course, you could use code SCRUBBY at the G Fuel checkout. It's a great way to get a discount on G Fuel. Help me out at the same time. I'd very much appreciate it. And, yeah, other than that, the only thing left down in the description is a link to the merch store. Feel free to go pick yourself up a t-shirt. On that note, guys, though, that'll do it. Don't get anyone pregnant. If you do, make sure they're hot, and hopefully I'll see you guys next time. I'm out. Peace.